Gentlemen, good day and welcome to the CreditAccess Grameen Q1FY25 earnings conference call. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Abhijit Teriwal from Motilal Oswal Financial Services Limited. Thank you, and over to you, sir.
Thank you, Sejal. Welcome everyone to the CreditAccess Grameen Q1FY25 earnings conference call. We have with us today from senior management, Mr. Udaya Kumar Hebbar, Managing Director, Mr. Ganesh Narayanan, Chief Executive Officer, Mr. Balakrishna Kamath, Chief Financial Officer, and Mr. Nilesh Dalvi, SVP and Head Investor Relations. With this brief introduction, let me hand over the call to the management for their opening remarks, post which we will open up the floor for Q&A. Thank you, and over to you, sir.
Thank you. Good evening to all, and a warm welcome for joining the conference call to discuss our first quarter FY25 business performance. Before we begin, I would encourage everyone to read our FY24 integrated annual report themed Being Sustainable and Responsible, which is available on our website. This report highlights our initiatives aimed at sustaining robust cross-cycle business performance, promoting strong governance and best practices, conscious effort to reduce our environmental footprint, and safeguarding the stakeholders' interests. As we reflect on the last quarter, it is evident that we navigated well, though a seasonally moderate period for microfinance, coupled with general election process during large part of the quarter. Despite facing challenges such as extreme heat waves across regions and operational limitations during general elections, we maintained consistent performance in our net interest margins, operating efficiency, and return ratios. Our overall AUM grew by 20.6% YOY to INR 26,304 crores. The GL book grew by 18.2% to INR 25,542 crores as against our annual guidance of 20%. While the RF book delivered a healthy growth to rupees 762 crores. The overall portfolio declined on a sequential basis in line with our internal estimates, given the seasonally weaker business momentum in the first quarter coupled with the general elections. We had factored this in our annual guidance of 23-24% portfolio growth in FY25, estimating a lower growth of 20% in group loan business as against 24.7% growth in FY24. Therefore, we reiterate our annual growth guidance for FY25 and we do not see any downside risk to our growth guidance. The disbursement stood modest at rupees 4,476 crores. We added 1.9 lakh new customers in Q1, leading to 12.7% YOY and 1.3% QOQ growth in the customer base to 49.84 lakhs. Our branch infrastructure stood at 1976, spread across 388 districts at the end of June 24, as we added 9 new branches during the quarter. The net interest income grew by 24.8% YOY to rupees 953 crore, in line with the loan portfolio growth. Our portfolio yield at 21% continued to remain the lowest in the microfinance industry, resonating with our belief in serving customers with the responsible pricing. On the other hand, the cost of borrowing was also stable at 9.8% despite the tightening liquidity scenario in the banking system. We expect our cost of borrowing will be within the range of 9.8 to 9.9% for FY25, guided by a healthy mix of domestic and foreign borrowings, along with maintaining a robust ALM position. While we operate with an interest spread of 11.2%, our NIM for the quarter stood at 13%, benefiting from our strong capital position and our balance sheet. The positive operating leverage generated due to the scale of our business, coupled with improved income profile, controlled costs resulted in a cost-income ratio of 29.2%. PPOP grew by 30.4% YOY to INR 709 crores. Coming to the asset quality, we saw a transitory increase in delinquency trend during the first quarter due to one low base impact on account of 1.5% QOQ reduction in our loan portfolio, to extended impact of low rainfall during last year, followed by a severe heat wave across several regions throughout the quarter, coupled with operational limitation during general elections, which impacted regular collections and follow-ups in the delinquent buckets, considering the election sensitivity of the borrower's profile. We have been anticipating a gradual increase in business as usual delinquencies over the past 3 quarters due to ongoing issues like temporary customer migration, rising customer leverage trends, third-party loan utilization issues, and higher steady-state delinquencies outside Karnataka. And accordingly, we had budgeted higher credit cost for FY25 compared to the previous year. We, however, expect the delinquency trend to stabilize in the coming quarter and credit cost within the guided range of 2.2 to 2.4% for the year. As you can see on slide 6, we continue to witness sustained partial repayments in the past 60 bucket, with an improving repayment trend as we move forward. Additionally, we have taken adequate measures like tightening credit filters while onboarding new customers, while extending new loan to existing customers, limiting overall leverage while dispersing, etc., and deploying senior and experienced field staff and business support teams to control the PAR trend in some pockets. Despite the increase in delinquency during the quarter, our asset quality continued to remain strong, with the collection efficiency excluding arrears of 97.8% for Q1FY25, PAR 90 plus at 1.13%, GNPA of 1.46 measured at 60 plus DPD, and net NPA of 0.45%. The credit cost of rupees 145 crore during the first quarter compared to rupees 153 crore during Q4 FY24 reflects our early risk recognition and conservative provisioning policy. Our initial provisioning stood at 2.29%, which is 116 bps higher than our PAR 90 plus and 130 bps higher compared to other provisioning norms. We have strengthened our initial provisioning policy further by aligning the provisioning rates based on district-specific risk compared to state-specific risk earlier, along with customer vintage. Our conservative approach of granular risk recognition and higher provisioning has historically positioned us to quickly navigate any potential asset quality cycles and capitalize on growth opportunities. We plan to implement district-based loan pricing in Q2 FY25, leveraging the business rule engine that would help align the loan provisioning rates on a granular basis. Thus, by tailoring loan pricing strategies based on district-specific factors, we not only aim to mitigate the potential risk, but also optimize revenue generation, safeguarding our overall returns. Our gross credit cost stood at 2.7% for Q1 FY25, while net credit cost stood at 2.6%, which is slightly higher due to transitory nature and base effect of Q1 as explained earlier. Coming to the return profile, Q1 FY25 PAT stood at rupees 398 crores, resulting in ROA of 5.4% and ROE of 23.5%, in line with our annual guidance. This is the 6th consecutive quarter where we have delivered ROA over 5% and ROE over 20%, resulting in sustainable profitability mirroring our strong cross-cycle performance. Looking ahead, we would like to reiterate our confidence in achieving our annual growth and profitability targets. Our strategic initiatives, coupled with the resilient business model and dedicated team, position us well to mitigate the known risk effectively. Lastly, before opening the forum for question and answer session, I would like to highlight the guardrails implemented by the industry body, MFIN, earlier this month, imposing a cap on microfinance budgeted to rupees 2 lakh, number of lenders to 4. The industry collectively has come forward to move towards a sustainable growth path, given large and untapped credit advancing opportunities available through microfinance channel. We look forward to your insights and questions as we delve deep into our Q1 FY25 result and strategic outlook. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi, good evening. Thank you for the opportunity. I have a couple of questions. Sir, the first question is, as we are defining this increase in delinquencies as temporary, have we already seen improvement in fresh par accretion in June and July? Or conversely, if you can share whether there has been improvement in the collection efficiency of June and July so far?
June and July is still remaining stable at the little higher frequency only, but we believe that the overall by Q2, this should improve. So what I'm trying to explain you is the 60 days was the general election time. You had difficulty in managing the collections, particularly going to field, going to do a follow-up of delinquent customers. That bucket would have moved further, whereas new par we are able to collect back or collect partially or moving backward. So therefore, overall your overall delinquent trend may remain same, but the new par actually ability to collect is much higher than the first 60 days.
Okay. And sir, you have mentioned about strengthening of the ECL provisioning policy in first quarter, and you have aligned your provisioning rates on districts versus states earlier, and also along with the customer vintage. But when I look at the ECL coverage on standard loans, which is stage 1 loans, it remains the same. So incrementally, as the growth picks up in the remaining quarters, would this ECL coverage percentage increase, right? Because more and more growth will come from the newer geographies.
Correct. It's right. When we realigned in all three buckets, you could see variation. For example, you have seen the standard asset, it has come down by 2 bps, whereas stage 2 it's gone up by 2% and stage 3 it's come by 1%. Correct? It's more of when we moved from a state level to district level, we moved to granularity. So some of the states, the actual numbers would have changed, the coverage. For example, take an example of Maharashtra. We decided as high risk state earlier. So now we move to district wise. Some districts move to medium districts, some districts move to low districts. The customers also move the same coverage buckets. So therefore, there is a one-time aberration or a change based on moving from a state level to granular level. And going forward, this would actually remain the same or follow the past 36 months trend. Actually, it get re-evaluated every quarter. So it's a one-time change because of the move from state to district and move to granular level.
And just lastly, we don't see any structural issues in any of the large markets like Bihar, Tamil Nadu, Karnataka, and Maharashtra in terms of rejection rates increasing or in terms of unique borrower acquisition challenges in these metrics. Are we seeing any issues at all? Because your guidance seems to suggest that things will come back normally in the coming quarters.
So there could be some stabilization because of the new guardrails which implemented. So because the overall, if the total borrowing of unsecured is more than 2 lakh, you may not be able to acquire the customer as per new guidelines, which is going to be common for the whole industry, not just for CAGL. But our view is that this will not impact too much because we always have this policy with us. Therefore, we don't see any challenge because of this. But yes, there is little increase in the rejection rates, but I think it will help us to acquire new customer to compensate that kind of rejections.
Got it, sir. Thank you and best of luck.
Thank you.
Thank you. The next question is from the line of Renish from ICICI Securities. Please go ahead.
Yeah, hi sir. Thank you for the opportunity.
Hi, Dinesh.
Hi sir. Sir, just two questions from my side. So one on the PAR 0 trend, right? I mean, if we exclude the Karnataka and Maharashtra, which has been the best performing state for us as well as I'm assuming for the industry, wherein we have 50% of our book. Now, if I exclude these two states, then the rest of the states PAR 0 is actually touching 4%. So it clearly suggests that there is some challenges across these states. Now, of course, this could be because of transitory in nature, because of election review, etc. But how one should sort of read this data? I mean, is this due to the over leveraging given the industry has been growing at an accelerated pace post-COVID? Or is there any structural change in the customer behavior? Because we have been hearing a lot, from the industry player that the center attendance is not sort of back to the pre-COVID level, and which of course tells us that the customer behavior has changed structurally. So, sir, where do you see PAR 0 settling down, in near term for us as well as for the industry?
So PAR 0, other than the core markets, it was little higher earlier also. That's why in our earlier call also we said that we have to increase our credit cost guidance because we continue to grow outside Karnataka. So therefore, it actually moved up by about 60 to 70 bits compared to earlier at the first quarter. We have to see the next actually maybe Q2. We feel it should stabilize from here. But on a continuous sequential basis, last 3 to 4 quarters, we have seen increase in the credit cost in the non-core markets. So therefore, we anticipated an increase of credit cost guidance.
Good afternoon. Good evening, sorry. So just a couple of questions. Firstly, on the MFIN rules, would you have a sense of what is the proportion of your borrowers who would be in breach of either of those two rules? Either they have more than 4 lenders or the exposure is more than 200K?
Okay. So our current analysis says there could be an impact of roughly around 8% of our. Yeah. But I think with new customer acquisition, we should be able to manage that.
Okay. And what is the typical plan of action for these borrowers in your case?
See, these borrowers are normally, if they are high vintage, good business, there's always a position for them to move to retail also, some of them. Because if it's a right business, right culture and opportunity, we'll actually have already that product, they can always move to them. Others, we may have to decline. Okay. But yeah, we have to compensate through a higher customer acquisition in such case.
And to a certain extent, the 2 lakh limit was an internal guideline already
we are following.
So it could have certain impact with 4 lenders. But I think that we should be able to compensate through a better run rate.
Got it. And the retail?
At least 2 lakh rupees already our internal guidelines. Even otherwise also would not have liked.
Understood, sir. Sir, and you have mentioned that you have tightened some credit filters. Can you please elaborate on what changes you have done exactly?
So one is whatever MFIN is asking, largely we are already doing it in our book. Top of that, we have certain geographical credit filters. We are using rule engine. For example, if we feel a state is high risk, we would do not even 4 lenders. We may do a 3 lender or a 2 lender. So it depends on our loan size variation based on the geography and risk. Pricing based on geography and risk. All these are filters which are using to rule engine. So it depends on each risk basis. We can actually play with the rules. That is what we are using.
And these tighter credit filters would be largely temporary, or these are more permanent in nature?
Depends on if the risk continues, we have to continue the filter, right? So if the so we will keep evaluating every quarter or 2 quarters and see if there is a variation. Whether we have to tighten or loose, we can do that. So good part is we have a right software, right engine to manage such things.
Perfect, sir. Thank you, Ganesh.
Thank you. The next question is from the line of Sebastian from DWS Investment GmbH. Please go ahead.
Hi, good afternoon. Thanks for the time and the opportunity. I just have a general question about the regulatory environment. I mean, it's like basically no week where the RBI, the regulator, is making any statements about for the banks, loan deposits, for the NBFCs. I mean, how do you expect the regulatory environment for the rest of the year to shape up? What kind of measures do you think the financial sector needs to put on itself in order to appease the regulator a bit more?
I think there has not been any further regulatory actions or indications except for pricing that the regulator is closely monitoring. However, the self-regulation that the industry has put in through the SRO is also in the right direction, right? So you are reacting much proactively to the market conditions, and that I think will go on the right way towards the regulatory governance.
On loans to NBFCs, I think it's more to NBFCs, whereas they exempted such kind of risk weight for private sector lending. So by default, any lending by banks to NBFC MFIs, so the rules are exempted, Sebastian.
All right, thank you.
Thank you.
Thank you. The next question is from the line of Hardik Shah from Goldman Sachs. Please go ahead.
Good evening, sir. Thank you for the opportunity. I have two questions. First one is on the borrower addition. Incrementally, what would be the proportion of NTC borrowers that we are onboarding? And on a stock basis, what would be the customers which would be unique to CredAccess?
So if you observe for last 4 quarters, we saw about 32%, 35% sometime the new to credit we observed, and we feel that will remain at that same trend, about 30-35%. And unique customer is in a little declining days because as we keep acquiring customer with from other MFIs, so unique will come down. Currently, we are at about 29% currently. So it's a small marginal change will happen as we add more and more customers with other customers belong to other MFIs or other lenders.
Understood. And sir, my second question is on the over leveraging. Your slides also mentioned that you're seeing some kind of over leveraging on ground, and also bureau data suggests that there is high level of retail loan exposure to the MFI borrowers, especially in the states of Karnataka and Tamil Nadu. So can you share some color on your portfolio? How much of your borrowers would have retail overlap in terms of number of customers as well as value, if you have that?
I think the percentage what mentioned, I think you are referring to CRIF high mark report.
Correct.
So largely it resonates in the whatever they talk to southern states, it resonates to us also. But it's more of a secured kind of book what we saw, like gold loans or a two-wheeler or a housing loan kind of thing, home loan. So which are longer tenor or somebody in the home other than the customers would be paying also. So we are not seeing any such impact because of that on our customers. Gold loan is one common thing across the country, across the southern part of the country, which is normally they would pay only interest and again keep renewing it. So therefore it won't impact as a leverage for our customer. However, in the last 3 quarters, what we observed is the leverage of the customer has increased by about how much? About 15% or something. Overall leverage we saw on a sample basis, not full customers. We saw that. Similarly, the FOIR or repayment load or something also increased by about 12%. So which we saw in our sample basis. We keep watching this and taking action, corrective action based on the pockets. As I said, we strengthen the management, strengthen the teams in the pockets where such things happen. We keep watching with the samples. We will not have full data, but we have to go by some samples.
And also,
wait a minute.
Also, our retail finance strategy will also take care of it, right? So the whole logic of building a retail franchise in CreditAccess Grameen is seeing the trend in which customers are availing retail finance loans, and the product that we've chosen also is in that nature. So as the customer's income profile improves, they have better credit history, they will have access to retail finance products from CreditAccess itself. So we can move them up as we move forward.
Interestingly, the retail finance delinquencies are much higher than the microfinance delinquencies that we see in the industry. Any specific reason for that? How do you read that? So you mentioned that is more secured kind of a book, but for example, housing loans are showing 30 plus DPD of as high as 10% as of March 24. So how do you read that data?
See, the difference between industry and Grameen is that we are doing retail finance with carefully selected products who have vintage with us. So who've got a credit history and relationship with us. So hence, we will always be better than industry even in this side of the business.
Okay.
See, one of the data point probably, what Ganesh says, is very important. So the unique to Grameen and vintage with Grameen, we have seen absolutely great trade pattern. So that is what we are actually capitalizing when we do the retail book.
Okay. Understood.
So
thank you, sir.
Your question. Thank you.
Thank you. Thank you, Karthik.
The next question is from the line of Shripal Doshi from Equirus Securities. Please go ahead.
Hi, sir. Good evening, and thank you for giving me the opportunity. So just one question on the classification of states in terms of low risk, medium risk, and higher risk. So have we seen any deterioration in the last one quarter, given that the PAR number in states like, as you highlighted, Rajasthan, Kerala, Jharkhand has increased, and also in the slide that we have given in presentation, it shows that even states like Bihar have elevated PAR 0 number. So have you seen the risk classification changing for some of the key states for us?
So risks actually now we move to districts. So state-wise risk we stopped tracking now, but you can see when you do the state-wise, our total 29% portfolio was falling under high risk, whereas when you move to district, 34% fall into high risk, correct? And then medium actually 40-30. 40 moved to 40 in medium, it actually reduced to 30. Whereas low risk, it used to be 31% of the book actually moved up. And 35% of the book comes under low risk now because of this transition. Maybe that answers your question.
So okay, there has been some movement, is what you're trying to indicate, but not at state level, but more on district side. Okay.
Correct, more district side, correct.
Got it. So the second part, like with this new MFIN guidelines, do you expect that even in key states like Bihar and Andhra and the newer states that we were targeting for incremental growth, would see some moderation in our aspirations, given that these are already, like especially Bihar, UP, these are decently penetrated states in terms of MFI presence. So overall, our loan growth would also see some moderation in terms of versus our guidance in the presentation.
I think it's important to note that the industry body has come up with the self-regulatory assurance to all of us that we will rebuild or we will actually make it more resilient business going forward. I think we should anticipate this better and improved lending process going forward, because it is accepted by the whole body. Everybody came together under the banner. So this includes the MFIs, the SFGs, NBFCs, and the banks together. Today, all of us are part of one entity, MFIN, and then it's a responsibility, accepted by all of us together. So we believe it should be it should be better going forward if there is any moderation in growth. So I agree that there could be some moderation in growth for a shorter period, may not be a longer period. Short period, it could be some growth moderation for the whole industry. We too assumed a kind of little lesser growth. If you see, last year our microfinance growth was 24.7%. What we actually built for FY 24-25 is only 20%. So though our total growth we anticipated is 23-24%, microfinance growth is only 20%. So it is already inbuilt in our budget. So when we started our annual exercise this year, the little higher credit cost, little low growth in microfinance was anticipated.
Got it. Last one question. It is on center meeting attendance. So, what is the difference that we have when we talk about center meeting attendance in the state of Karnataka, which is probably the best performing state for us and for industry, versus probably the rest of the states? So for us, what would be the difference in terms of center meeting attendance?
So largely Karnataka, Maharashtra, Madhya Pradesh, Chhattisgarh, all are actually quite good in terms of attendance. Little deviation we could see in the other part of the country. So where we are a core market, we are top and first entry. So we have seen we are able to maintain that culture to large extent. But overall, still we have a good 50% attendance in most part of the country. Yeah, little higher in Karnataka definitely.
So what in Karnataka, for example, like just to benchmark it?
Karnataka may be about 70-72%, and then overall market may be 52%. Approximately, I'm not able to give right now here, but overall, sense I am having.
Got it. Okay, sir. Thank you so much for answering my questions, and good luck for the next quarter.
Thank you.
Thank you. The next question is from the line of Ajit Kumar from Nomura. Please go ahead.
Thanks for the opportunity. So my first question is, the regulator has been instructing MFI lenders to lower growth in Bihar and UP as per various news articles. Is there any communication that is currently going on with the regulator on this? And also your portfolio in Bihar and UP has become like 3 times and 4 times respectively between FY 22 to 24, much higher than the overall AUM growth. Are you going to intentionally tone down growth in these states? So that that would be my first question.
The first is, I think there is no communication from RBI to any MFIs. Okay, maybe we have seen only news article. We also see a new article, nothing else. So we have not heard from anybody that RBI wrote to anybody to reduce or made any statement about it. In terms of growth, I think we continue to do the calibrated growth. We continue to watch the industry, watch the risk of each district, and accordingly we'll go. So I think our growth, what we estimated is not very high. Therefore, we will still continue to grow with the calibrated manner in those states also. But Bihar, we are not planning any branch openings because we have sufficient branches there. It's only growing in the branch where we already have existing branches. That's UP probably we expect to add some more branches, but our major growth should come from new branches should come from AP, Telangana or West Bengal.
Okay, sure. And sir, in order to achieve this 23 to 24% AUM growth, target in FY25, what is the disbursement growth target in FY25?
It's similar, about 23-24% disbursement growth.
Okay, for the full year, right?
Yeah, correct.
Okay. So, sir, in that context, disbursement growth in remaining FY25 has to be around roughly, you can say, 28 to 30%. Don't you think that is a steep task given soft disbursement even in July and August? And if we see in last year, disbursement growth during 2Q24 to 4Q24 versus, let's say, 2Q23 to 4Q23 was only 12%. So this disbursement, growth target seems, little bit on a higher side.
No, annualized growth last year for Q1, Q2 together, it was about 14%. And the balance in the period, we actually achieved the 23%. 49 was less actually. It's 8% growth come in the first 2 quarters, and we reached 20%. So 27%. That means 19% growth we achieved between Q3 and Q4 last year.
Okay.
So we believe in microfinance normally 60 to 65% growth comes in second half.
Sure. That is achievable.
Yeah, correct. You are right.
Okay. Thank you, sir. Thanks a lot. That's it from my side.
Thank you.
Thank you. The next question is from the line of Raghav Garg from Ambit Capital. Please go ahead.
Hi, thanks for the opportunity, sir. I just have one question.
Sorry to interrupt you, sir. May I request you to please use your handset?
Sure, just give me a minute. Audible?
Yes, sir.
Audible.
Okay. Yeah. Sir, just one question from my side. When you look at the food inflation data, that food inflation has been quite persistent, and it matters even more as food expenditure, as part of the overall expenditure is pretty large for bottom of the pyramid customers given their income levels. And rural wage growth in real terms has been negative for last quite a few quarters. On the other hand, you have a typical MFI customer seeing about 10 to 11% increase in exposure levels on a YOY basis. So in light of this, how do you expect the repayment capacity to evolve over the next 12 months for your customers, or if you can comment on the broader industry, that will be very helpful. Thanks.
I think we've seen in history in kinds of inflation, our customers who are largely into similar profiles earn a little more, and sometimes it also gives a negative correlation to collection. Having said that, whatever self-regulation that MFIN has imposed upon, I think this will limit any kind of over-leveraging that could build up over the next few quarters. And it should improve from here. I don't see it deteriorate from where it is today over the next few quarters. It should improve from where we are.
Understood. That's all from my side.
Thank you. The next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead. Mr. Sarvesh, may I request you to please unmute your line and speak?
Yeah, good evening, sir. Thanks a lot for giving me the opportunity. Most of my questions have been answered. Just one question on this, overall sort of delinquency that we are seeing. I think, you have been alluding to these being majorly caused by the election and the heat waves. But at the same time, there are a lot of concerns in the news reports that we have been reading about over leveraging and this sort of credit cost being expected to go up along with that. So how do we reconcile both this information? I mean, this is just a Q1 phenomena which should stabilize by, let's say, Q3 for you, or we are still in a wait and watch mode to understand how things will shape up with respect to delinquency, especially in the non-core states.
Yeah. See, I think about the delinquency potential in the non-core states, we had anticipated that there will be little higher credit cost compared to the core states. That is mixture of all these things. It's over leveraging, it could be customer migration, it could be political or some local interventions, or many other parts of it. There will be what I explained is a major reason why which the credit cost is increased because of the sensitive period of 60-70 days, your ability to follow up and convince the customer was less due to the sensitivity. That is what the major reason. Therefore, the buckets have moved further. Okay. So now what I'm telling is that after that, I think the ability to go back and talk to customer and convince them to repay is higher. Therefore, your ability to control the credit cost is higher. So we can keep listing many other reasons also, but we only give the high frequency reasons during the quarter. And our strong belief that this is a one time and little higher. And we also saw, as I said earlier, we saw 3-4 quarters, there's a little increase all the time in the non-core states. That's the reason we do little higher credit cost. So I just explained that also earlier.
And it also appears, from your comments as well as what the industry body is trying to do, that any such, effort to contain the credit cost going forward would be at a significant cost to the industry growth rate in terms of the AUM. So would you agree with that sort of a statement?
So it depends. If somebody wants to go and lend to the same customer in the industry, then what you say is right. But there is still opportunity, because as per the industry estimate also, your potential customer in microfinance is almost 16 crores. And what you address is only about 8 crores so far. So if you spread around the acquisition formula and go to the place where go to deep rural or instead of doing in only cities, I think still you have good opportunity.
And sir, finally,
widespread. There should be growth has to come from customer acquisition route, not by particular increasing ticket size. That's all.
Understood. And sir, finally, at the same time, we are also seeing normal sort of rainfalls across the country. So, that is expected to sort of help the rural economy. So do you expect any upsides happening because of this? Because last year was also not so good on that account. So in your model projections and what we are seeing on the ground, do you see any upsides coming from a normal rainfall?
So it should actually help to stabilize further on the credit cost and collections actually. Automatically, when the rainfall is normal, job level is improved, agriculture level improved, I think it will only improve the collection efficiency and the rest of the vehicles. Demand will go up. It's always positive.
Understood. Thank you and all the best.
Thank you. The next question is from the line of Nidesh from Investec. Please go ahead.
Thanks for the opportunity. Sir, you mentioned in the presentation that you're tightening your filters by onboarding new customer and extending new loans to existing customers. What exactly we are doing here, and what will be the target in terms of new customer acquisition for FY25?
So target customer for new customer acquisition, I think we already told it's about 13-14% will be our customer growth what we anticipate for 24-25. And the tightening is both sides. One is renewal and one is about the new customer. And even both cases, the tightening will be different in different states, probably different districts. Depends on the risk behavior. We may like what I said earlier. If though MFIN said 4 customer, not more than 4 lender. So many states we have only 2 lender as per rule. Maybe some districts will go into 2, even though only 2 lender or less. So it's all actually based on the risk, Nidesh. We will not have a general rule for everything. We go by the risk and reacting to the risk in each district level. So the granular checking given risk, anticipating risk, tightening the rule, placing it appropriately, and provisioning accordingly. All 3 go with the correlation actually. All 4 items go correlation at a granular level.
And if I may add, with us adopting the rule engine, we've got a lot more power in hand. So all our attempt is towards making this a lot more finer, making it a little more resilient than what it was when we were doing it at state level. So we could work on many variables, including repayment obligations of customers, like some of you pointed out, their overall leverage, including retail loans. We can even look at many other variables as we move forward, right? So we can work on PIN codes, we can work on certain villages, whatever we want, we have the power to do it. So we are able to look at things a lot more granular than what we used to do earlier.
Sure. And secondly, in terms of R0, do you think this has peaked out here, or there is a possibility of further increase in R0 from the current levels?
Our belief it's a peak out, it will be stable for some time and start coming down also.
Okay. Thank you, sir. That's it from my side.
Thank you.
Thank you. Ladies and gentlemen, we will take that as the last question. I would now like to hand the conference over to the management for closing comments.
Thank you everybody for joining at the late hours. So look forward for the next quarter and look forward for the support. Thank you so much. Have a nice good evening.
Thank you.
On behalf of Motilal Oswal Financial Service Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.